In episode 2, we are going to talk about session liquidity, how to identify it, and how to use it in your trading. It is one of the easiest liquidity pools to understand, so let's get straight into it. First, I want to clarify something that most of you are already familiar with, but it is important to understand it clearly and correctly. In the financial markets, there are 3 primary trading sessions. While there are a few minor sessions as well, they are not relevant for what we are discussing. The 3 main sessions that the majority of traders focus on are the Asian session, the London session, and the New York session. These sessions are significant because they are the periods when the highest amount of liquidity is present in the market. When liquidity is high, the market operates in a more efficient manner. Price movements become smoother and more structured, rather than random or excessively choppy. The price action during these sessions is generally cleaner and easier to analyze, which is why most traders choose to participate in the market during these specific times. In addition to trading directly within these sessions, they can also be used as an important framework for identifying high-probability trading opportunities. This is the concept that will be explained in this video. Each of these sessions forms its own trading range, and within that range, the market creates clear highs and lows. These highs and lows represent areas of liquidity, which are often targeted by large market participants and institutional traders. The Asian session is the first major session of the trading day. During this session, price establishes an Asian high and an Asian low. Typically, significant directional moves are less common during the Asian session. Instead, the primary purpose of this session is to create liquidity. Once the Asian session ends, we mark its highs and lows and wait for the next major session to begin. The session that follows Asia is the London session. When the London session opens, the market often reacts to the liquidity that was formed during the Asian session. For this reason, during the London session, the Asian session highs and lows become key reference points. Price frequently moves toward these levels before making a meaningful directional move. After the London session, the market transitions into the New York session. Just as the Asian session creates its own liquidity, the London session also forms its own highs and lows. These London session highs and lows then act as liquidity targets for the New York session. It is common to see price move toward London session liquidity during the New York session before continuing or reversing direction. One important rule in this framework is that New York session highs and lows are not used in the same way. The reason is straightforward. Once the New York session closes, the Forex market closes for the day. There is no subsequent major session that follows New York to take that liquidity. Because of this, New York session highs and lows are not considered relevant liquidity targets within this specific model. In simple terms, the Asian session creates liquidity that is utilized during the London session, and the London session creates liquidity that is utilized during the New York session. Although this concept is simple, when it is properly understood and combined with market structure and price action, it becomes a highly effective tool for identifying high-quality trading opportunities. So here you can see that I have already marked everything that I explained earlier. To make it absolutely clear, let me explain once again how and where we are going to use these session highs and lows. The Asian session is the opening session of the trading day, and during this session, we allow the market to create its initial range. In most cases, we avoid taking trades within this Asian session range, as its primary purpose is to form liquidity rather than produce strong directional moves. When the market moves into the next session, which is the London session, we begin to use the highs and lows that were formed during the Asian session. These Asian session highs and lows are treated as swing highs and swing lows. They act as liquidity targets and reference points from which we look for trade opportunities during the London session. In the same way, when the market transitions from the London session into the New York session, we shift our focus to the highs and lows created during the London session. These London session highs and lows are then used in the New York session in exactly the same manner, as swing highs and swing lows, and as areas of liquidity where we look for potential trade setups. So in simple terms, This is the process of how we use session highs and lows in our trading. The Asian session creates the range, the London session uses Asian liquidity, and the New York session uses London liquidity. Now that this concept is clear, let me show you some practical examples on the charts and explain how to take trades using these session highs and lows in real market conditions. There is one more important aspect to this concept that you must understand. Along with identifying and using session highs and lows, it is essential to align your trades with your overall market bias. Session liquidity by itself is not enough. It must always be used in combination with directional bias and draw on liquidity. What this means is that session highs and lows are not restricted to only the immediate next session. While Asian session highs and lows are most commonly used during the London session, they can also be used in the New York session if those levels have not yet been swept. If the Asian highs or Asian lows remain untouched after the London session, they can still act as valid liquidity targets during the New York session. However, the key condition is alignment. These levels should only be used if they align with your higher time frame bias and your expected draw on liquidity. If your bias is bullish, you should be focusing on unswept highs as potential liquidity targets. If your bias is bearish, you should be focusing on unswept lows. Taking trades without this alignment significantly reduces the probability of success. So in simple terms, session highs and lows can be used across multiple sessions, as long as they remain unswept and are in alignment with your directional bias. When you combine session liquidity with market structure, bias, and draw on liquidity, you are no longer trading randomly. You are trading with intention, logic, and a clear framework behind every decision. So now we are on the charts, and the first thing we need to do is determine our directional bias and identify our draw on liquidity. As you can see, when we mark out the range on the 4-hour time frame, we start by observing where price is most likely to retrace. In this case, there is a 4-hour order block located below the discount level. Based on this structure, this area becomes our primary draw on liquidity, as it represents a logical target for price to move toward. Once our higher time frame bias and draw on liquidity are clear, we shift down to the 1-hour time frame. On the 1-hour chart, we look for signs that price is beginning to align with our bias. Here, we can clearly see a 1-hour bearish market structure shift, which further confirms our expectation that price is likely to move lower. After identifying this shift, we mark out the relevant range and evaluate whether there are any key levels at or above the discount zone from which we can look for trade opportunities. Next, we drop down to the 15-minute time frame. On this time frame, we observe that the Asian session high is positioned very close to the equilibrium of the range. At this point, we are not interested in entering immediately. Instead, our plan is to wait for this Asian high to be swept, as it represents a pool of liquidity that price may seek before continuing in the direction of our bias. As you can see, during the London session, price does not retrace high enough to sweep the Asian session high. Because of this, we remain patient and do not force a trade. Eventually, at the New York session open, price moves higher and successfully sweeps the Asian session high. This liquidity sweep provides further confirmation that price is likely ready to continue toward our draw on liquidity. After the sweep occurs, we then drop down to a lower time frame to look for precise entries. On the 1-minute time frame, we wait for confirmation before executing a trade. There are many types of confirmations that can be used at this stage. Personally, I prefer to use inverse fair value gaps as my entry model. Once price forms an inverse fair value gap in alignment with the higher time frame bias, I execute the trade from that level. The target for this trade is the 4-hour order block that we identified earlier as our draw on liquidity. As you can see, price moves directly toward this target without hesitation. The move is clean, efficient, and delivers a large reward, which is a result of aligning session liquidity, market structure, directional bias, and draw on liquidity into one complete framework. After that, as we discussed earlier about using London session highs and lows during the New York session, we can see the same concept playing out here. Price moves into the 4-hour order block and successfully fills it. At the same time, you can also see that price sweeps the London session lows. This confirms that London session liquidity is being taken during the New York session, exactly as expected within this model. Now, before looking for any new entries, the next step is to identify our draw on liquidity. At this point, our directional bias is already confirmed. Price has clearly respected the 4-hour order block, which tells us that our bias is bullish. However, even though we know the direction, we still need to determine where price is likely to move next. When we look at the 4-hour external range, we can see that there is an order block located in the premium of the range. This order block becomes our next draw on liquidity, and based on this structure, we can reasonably expect price to move toward that level. Once our draw on liquidity is defined, we shift down to a lower time frame to look for precise entries. On the lower time frame, we can see the formation of an inverse fair value gap. This gives us a clear and objective entry model. We can enter the trade from this inverse fair value gap, place our stop loss below the recent low, and target our identified draw on liquidity. It is important to note that you do not need to target the absolute highs of the range. I personally recommend focusing on a fixed risk to reward, such as 1 to 4. For the purpose of this video, I am simply showing that if price moves toward our draw on liquidity, the target can be reached comfortably. As you can see, price moves cleanly into our target area without difficulty. This is how you combine session-based liquidity with directional bias and draw on liquidity alignment. When all of these elements are in place, the trade becomes structured, logical, and repeatable, rather than based on emotion or guesswork. That's it for this video. If this helped you, make sure to like the video and subscribe to the channel. If you want to join my mentorship program, the link is in the description. And for any questions or doubts, you can join my Discord. I'll see you in the next one.